Okay, so you want to own a private jet company. You buy 3 early model Challenger 300 series jets for $8.5 million each. The fleet looks magnificent on the ramp. The passenger paid for 1 flight. You may have to operate 2. Polished paint, leather cabins, 8 or 9 passengers per aircraft. Enough range to connect the major cities of the eastern United States without turning every trip into a fuel stop. Then your first customer calls. They want to fly from Miami to New York tomorrow morning. For this model, you quote $12,000 per occupied flight hour before taxes and trip-specific pass-through charges. The trip lasts about 2.5 hours. The base flight invoice reaches roughly $30,000. The customer boards in Miami, lands in New York, and walks away believing they just paid an extraordinary amount of money for 1 flight. But your next customer is not in New York. They are in Nashville. So the same aircraft takes off again. The pilots are still paid. The engines are still consuming fuel. The maintenance clock is still moving. The flight still requires weather planning, airport coordination, handling, and dispatch support. Only this time, every seat is empty. The passenger paid for 1 leg. You paid for 2. That is the first paradox of this business. A private jet can be in the air all day and still spend too much of that day producing no passenger revenue. By the end of this video, you will understand the 3 realistic stages of entering private aviation, what a Part 135 certificate actually allows you to do, why aircraft management can be more attractive than aircraft ownership, how empty repositioning destroys apparently enormous margins, why a scaled operator can generate hundreds of millions of dollars in bookings and still lose money, and how 2 identical 3-jet fleets can finish the year more than $6.5 million apart. Because you are not buying only 3 aircraft, you are buying a moving inventory problem. Every customer wants the airplane in a different city. Every airplane begins the day somewhere else. And the gap between those 2 locations is where your profit disappears. Before you buy a jet, decide which private aviation risk you are ready to own. The first stage is the charter broker. A broker does not need to own an aircraft. The broker finds the customer, identifies a certificated operator with the correct airplane, negotiates the trip, adds a margin or commission, and coordinates the transaction. This is the lowest capital version of the business. You still need salespeople, software, insurance, legal structure, supplier relationships, customer support, and enough working capital to handle deposits and timing differences. But you do not need a $25.5 million fleet. The advantage is flexibility. A broker sells the trip. A certificated operator is responsible for the flight. If the customer wants a light jet today and a super mid-size jet tomorrow, you shop the operator network instead of forcing 1 fleet to fit every mission. The disadvantage is control. You may own the customer relationship, but another company controls the airplane, pilots, maintenance, and legal operation of the flight. The Federal Aviation Administration warns that a broker cannot present itself as the direct operator or assume operational control unless it holds the required authority. Your brand can make the promise. Someone else must physically deliver it. The second stage is aircraft management. A wealthy individual or company already owns the airplane. They do not want to recruit pilots, schedule maintenance, negotiate insurance, arrange hangar space, clean the cabin, or build a flight department. You manage those functions for a monthly fee. If the owner wants to reduce the cost of ownership through charter, the aircraft must be placed with a properly certificated Part 135 operator. That may be your own certificated company, an affiliated operator, or an independent partner. Management by itself does not transfer operational control. This stage allows you to learn supply before financing every aircraft. The owner provides the asset. You build the operating relationship, earn management revenue, and may receive a share of approved third-party charter activity. The third stage is the Owned Fleet Part 135 operator. Now, you own or lease aircraft, place them on your operating specifications, employ the required team, and sell charter under your own authority. Under the FAA's Basic Part 135 scope, an operator is limited to 5 pilots, 5 aircraft, and 3 aircraft types, with additional geographic and seating restrictions.
That sounds large enough for 3 jets.
But the 5-pilot cap is a poor fit for a 3-aircraft, 2-pilot, high-availability charter operation.
Our modeled company, therefore, uses a standard Part 135 structure, with the deeper management, training, and staffing system required to support the fleet. At this stage, the business becomes operationally real.
You are responsible for crew qualifications, maintenance status, dispatch decisions, weather, duty limits, passenger safety, and whether the flight should happen at all. Only after these 3 stages comes the national platform.
That is not a realistic starting point.
It is the scaled destination. Dozens or hundreds of aircraft, multiple categories, a 24-hour operations center, memberships, maintenance capacity, and third-party lift for overflow. The customer is no longer buying one tail number. The customer is buying availability. For the rest of this episode, we will follow the third stage, a standard Part 135 company that owns 3 similar Challenger 300 series jets. That is large enough to expose the real operating machine, and small enough that one empty leg, one maintenance event, or one lost customer can still change the entire year. The certificate is not paperwork. It is the operating system behind the airplane. Buying an aircraft does not give you the legal right to sell charter flights to the public. The airplane is an asset. Commercial authority is a separate system. In the United States, on-demand charter generally operates under Part 135. That brings higher pilot qualification, training, maintenance, and operating requirements than a private owner flying under less restrictive rules. The FAA reported 1,837 Part 135 certificate holders and 11,582 authorized aircraft in its charter guidance. To the customer, the difference can be invisible. The same model of jet can sit on the same ramp with the same number of seats. One aircraft may be used privately. Another may legally carry paying charter passengers because it is listed on an operator's specifications, maintained under the correct program, and flown by appropriately trained crews. The certificate creates responsibility. Someone must decide whether weather is acceptable. Someone must verify pilot duty time. Someone must confirm that the aircraft is airworthy, the inspection is current, and the route is legal. Someone must maintain manuals and training records. Someone must monitor drug and alcohol testing requirements. Someone must answer the regulator after an incident. And someone must have operational control. That final phrase matters. Operational control means the authority and responsibility to initiate, conduct, and terminate the flight. A customer can request the trip. A broker can arrange it. An aircraft owner can make the airplane available. But the certificated operator must control the operation. This is why the company cannot be built like an ordinary marketplace that simply connects supply with demand and walks away. The aircraft may cost millions and remain a saleable physical asset. The operating authority is different. You cannot detach it from the organization and transfer it like an airplane. Without the people, manuals, training, maintenance control, and operating specifications behind the certificate, your expensive aircraft cannot legally become the product you planned to sell. And compliance does not disappear when the aircraft is parked. Your chief pilot, director of operations, maintenance leadership, manuals, software, insurance, and recurrent training exist before the first customer calls. That makes the business expensive before it becomes busy. A restaurant can hire another server when reservations rise. A charter operator must build much of the safety organization before the revenue arrives. So, the certificate is not merely permission to sell flights. It is a fixed-cost machine designed to prevent your sales team from promising something your operation cannot safely deliver. Let us return to the 3 Challenger 300 series jets. Assume each aircraft is an older, higher-time example acquired for $8.5 million after a serious pre-purchase inspection. 3 aircraft create a $25.5 million purchase price. Then you add conformity work, legal review, initial maintenance, cabin updates, spare parts, pilot training, insurance deposits, systems, and working capital. Our modeled company opens with an all-in investment of $29 million. That sounds like the cost of entering the private jet business. It is only the visible part. The aircraft is not one expense. It is several expenses tied together. First comes financing. A lender does not care whether your airplane carried a customer today. The payment still arrives. Second comes depreciation and market value. Aircraft are mobile assets with visible histories. Age, total time, engine cycles, maintenance status, damage history, cabin condition, and market demand all affect resale value. A cheap airplane with an expensive inspection approaching may not be cheap. It may be a future invoice disguised as a discount. Third comes the engine and maintenance clock. A hotel room never wakes up in another city. Your inventory does. A jet engine is not maintained only when it breaks. Routine maintenance, hourly engine programs, scheduled inspections, and life-limit components all follow different clocks. Every takeoff matters. A short flight may generate less revenue than a long flight while still adding another cycle to the aircraft. Fourth comes crew. A Challenger 300 charter trip requires 2 qualified pilots, but 6 pilots would not create a resilient 3-aircraft operation. You need enough people to cover duty limits, illness, vacations, recurrent training, positioning, and irregular customer schedules. 2 pilots per airplane is only the number visible in the cockpit. It is not the complete staffing plan. Fifth comes the operating base. Hangar space, office space, dispatch systems, cleaning, catering coordination, ground support, and airport relationships all cost money. And then comes the inventory problem. Your customer does not care where the aircraft slept. They care where they want to depart. This is the fundamental difference between a private jet and a hotel room. A hotel room never wakes up in another city. Your inventory moves after every sale. The aircraft that earned revenue by flying to New York has also removed itself from Miami. Every completed trip changes the location of the product you must sell next. So you are not only buying aircraft, you are buying a fleet positioning problem that resets after every customer. Private aviation has 2 kinds of flight hours. The live leg carries the paying customer. The repositioning leg moves the aircraft to the customer, to the next customer, to maintenance, or back toward the part of the country where you believe demand will appear. Both legs consume the airplane. Only one is easy to invoice. Suppose a customer books a 2-hour flight. At $12,000 per occupied hour, the visible trip produces $24,000 of flight revenue before taxes and pass-through charges. Now imagine the aircraft must fly 1 hour empty to reach the customer, and another half hour after the trip to meet tomorrow's passenger. The customer bought 2 hours. You operated 3.5. In our Challenger 300 series model, direct operating cost averages $5,100 per actual aircraft hour. That includes fuel, routine hourly maintenance, and engine program accruals, trip crew travel, handling, and other movement-related costs. The aircraft therefore consumes $17,850 before fixed overhead. If you looked only at the customer's 2 occupied hours, the apparent spread would be $13,800. The real trip contribution is $6,150 because the aircraft actually flew 3.5 hours. Now, the fixed system still has to be paid: salaried pilots and recurrent training, insurance, hangar, maintenance administration, dispatch and safety, sales and customer support, debt. And the trip that looked enormously profitable becomes a very ordinary contribution. This is why operators care about fleet utility and geographic density. Wheels Up reported 41 average revenue-generating hours per available aircraft per month in 2025. Its metric excludes empty repositioning. The empty leg is not a cheap product. It is an expensive problem you are trying to recover. In the first quarter of 2026, the company reported 47.6 utility hours per month for its Phenom 300 series, 56.1 for its Challenger 300 series, and 29.2 for its legacy aircraft. Those figures do not tell us total aircraft movement because repositioning is excluded. They are also company-specific measures, not national averages. But they reveal how much economic difference can exist inside one fleet. An aircraft producing 56 live hours per month has far more opportunity to cover its fixed system than one producing 29. The operator can try to sell an empty leg at a discount. This is the famous empty leg deal. A passenger receives a lower price because the aircraft is already moving, but the customer must accept the route, date and timing created by someone else's schedule. The empty leg is not a dependable product for most travelers. It is a recovery tool for the operator. The best result is not selling empty flights cheaply. It is avoiding unnecessary empty flights in the first place. That requires repeat demand in concentrated cities and a scheduling system capable of seeing tomorrow's network before accepting today's attractive trip. A small operator sees a $24,000 booking. A strong operator asks where the airplane ends up. The obvious revenue source is owned fleet charter. You own or lease the aircraft, sell the occupied flight, and collect the customer revenue. This creates the highest visible upside. It also leaves you with the debt, depreciation, maintenance, crew, and empty flight risk. But charter is only one layer. A private owner has already written the aircraft check. You manage crew, maintenance, hangar, insurance administration, scheduling, and owner trips for a monthly fee. If the aircraft is approved for third-party charter under a certificated operator, the management company may also receive charter-related revenue. In its historical public filings, Volato described management contracts under which owners paid management fees and aircraft operating expenses, while the company generally received 15% of revenue from third-party charter trips. That percentage is not an industry standard. It demonstrates the structural attraction. The aircraft owner is trying to reduce the net cost of a personal asset. The management company is trying to build supply without financing every tail. Instead of selling one trip, you sell future access. The customer deposits money, buys a block of hours, pays a membership fee, or purchases a fractional interest. The program may promise fixed pricing, guaranteed availability, a service area, or response time. NetJets currently says its U.S. solutions begin at $215,000 for a jet card, with actual cost depending on aircraft and access structure. The customer gains certainty. The provider receives commitment and better visibility into future demand. But every promise becomes an obligation during holidays, storms, and peak travel periods. When your fleet is unavailable or the customer needs another aircraft category, you can purchase capacity from another certificated operator. This protects the customer relationship and allows you to sell beyond your own fleet. It can also compress margin. If your aircraft breaks after you quoted the trip, the replacement may cost more than the customer paid you. A scaled operator may also earn from maintenance, parts, refurbishment, and aircraft transactions. Those activities can reduce downtime and keep more of the aviation budget inside the company. The customer buys hours. You own every gap between them. But they are not the first economic engine of our three-aircraft operator. The important question across every model is the same. Who paid for the airplane? Who carries its fixed cost? And who receives money before the aircraft moves? All of these revenue streams sound attractive, but none of them matters if the basic aircraft movement fails to produce contribution. So before we build a fleet, let us test one trip. A customer wants to fly from Atlanta to Teterboro, the business aviation airport near New York. Assume the billable flight time is 2 hours. Your modeled occupied rate is $12,000 per hour. Base flight revenue is $24,000. Now build the actual movement. The aircraft begins in Charlotte. It flies 1 hour empty to Atlanta. The customer boards. The aircraft flies 2 hours live to Teterboro. After the passenger leaves, the airplane flies 1 hour empty to Washington, where tomorrow morning's customer begins. 4 hours of aircraft movement, 2 hours of passenger revenue. At $5,100 of direct operating cost per actual hour, the aircraft consumes $20,400. That leaves $3,600 before fixed aircraft cost, sales, operations, administration, debt, and major capital reserve. The customer saw a $24,000 base flight charge. You saw $3,600 of trip contribution. Now change only the network. Suppose another customer wants Teterboro to Washington after the first passenger arrives. The 1 hour repositioning leg becomes a live leg. At the same modeled rate, the aircraft generates another $12,000. The airplane flies the same 4 hours. Direct movement cost is almost unchanged. Revenue rises from $24,000 to $36,000. Trip contribution rises from $3,600 to $15,600. Nothing changed about the aircraft. Nothing changed about the pilots. Nothing changed about the first customer. You simply sold 1 hour that was already going to happen. That is route density. The small operator tries to win a trip. The network operator tries to connect trips. A lower margin flight into a high-demand city can be more valuable than a higher margin flight that strands the aircraft in a place with no next passenger. The destination is part of the price. The clock is part of the price. And the position of every other aircraft in the fleet is part of the price. You are not selling independent flights. You are assembling a moving schedule where each sale changes the value of the next one. The ordinary cost stack is already heavy. Direct movement cost includes fuel, routine hourly maintenance and engine program accruals, trip crew travel, handling, and airport charges. Fixed cost includes salaried crew, recurrent training, insurance, hangars, subscriptions, maintenance administration, dispatch, safety, sales, and debt. But 3 shocks are especially dangerous because they appear after the customer has already been promised a flight. A crew can finish a trip far from home. You may need to keep the pilots with the airplane, fly them commercially to another city, or bring a replacement crew into position. The customer sees 2 pilots in the cockpit. The owner sees an entire staffing network moving behind the aircraft. And the trip can still become impossible if the legally available crew runs out of duty time. Routine inspections can be planned. Unscheduled failures cannot. When an aircraft becomes AOG, aircraft on ground, revenue stops while mechanics, parts, and specialists move toward it. If one of 3 jets is unavailable, 1/3 of your owned fleet disappears. The customer may still need to travel. You can cancel and damage the relationship. Or you can buy a replacement charter from another operator, sometimes at a higher price than the customer paid you. Saving the customer can mean deliberately losing money on the trip. A broker can say no when the market is empty. A membership or jet card provider has sold the idea that it will say yes. Peak day demand forces the company to preserve spare capacity, reposition aircraft early, or purchase expensive third-party lift. Guaranteed access sounds like marketing. Operationally, it is inventory held for the day everyone wants to leave at once. This is why the premium is not only for leather seats. The premium pays for legal crews, maintained aircraft, recovery capacity, and the backup plan the passenger hopes never to see. Hundreds of millions in bookings can still produce a loss. The clearest answer to the whole aircraft problem is fractional ownership. NetJets did not invent the desire to fly privately. It changed what the customer needed to own. Instead of buying one complete airplane and building a flight department around it, the customer can buy a share, lease access, or purchase a jet card. The customer receives access to a category of aircraft supported by a large operating platform. Berkshire Hathaway describes the shared ownership concept as a way to give customers the scale, flexibility, and access of a large fleet instead of relying on whole aircraft ownership. Its programs focus on guaranteed availability, predictable operating cost, and liquidity. That is the moat. A single airplane has one location, one maintenance schedule, and one cabin size. A fleet can substitute. If a particular aircraft is under maintenance, another one can serve the trip. If the customer needs more range, the platform can move them into another category. If a storm displaces aircraft across the East Coast, the operations center can rebuild a network instead of defending one tail number. NetJets says more than 80 new aircraft are expected to join its fleet during 2026. The point is not that buying 80 airplanes automatically creates a good business. The point is what those airplanes support. The company is selling confidence that an aircraft will appear when promised. That confidence depends on fleet depth, crew depth, maintenance capacity, demand forecasting, and customer contracts. The physical product is still a private jet. The commercial product is a service level. This changes the owner's objective. A single aircraft owner wants maximum use of one airplane. A fleet platform wants the right aircraft utilization across the entire network while preserving availability. Sometimes that means an airplane sits. Sometimes that means it repositions. Sometimes that means the company buys a third-party flight even though it owns hundreds of aircraft. The customer does not purchase the most efficient routing plan. They purchase the right to ignore the routing problem. The company earns its margin by solving that problem better than the customer could alone. You cannot copy the size of that network with 3 aircraft. But you can copy 2 principles. Standardize the fleet so aircraft, crews, and maintenance can substitute for one another. And concentrate demand geographically so the next customer is more likely to begin near the last customer's destination. Those principles are available before national scale. Scale solves some problems, it creates others. Now look at Wheels Up. In 2025, the company reported $833.9 million in private jet gross bookings and 44,694 live flight legs. Average gross bookings per live flight leg reached $18,658. This is not a tiny operator searching for its first customer. It is a national aviation brand processing tens of thousands of flights. Yet its financial statements tell a much harder story. Wheels Up reported $736.5 million in revenue for 2025. Cost of revenue was approximately $662.8 million. After depreciation and amortization, reported gross profit was only $12.6 million, or a 1.7% gross margin. Total operating expenses pushed the company to a $203.4 million operating loss. Net loss was approximately $294.2 million. At year-end, total debt was approximately $671 million. The company also used substantial operating cash during the year. These figures do not prove that private aviation cannot work. They demonstrate the danger of confusing customer demand with owner economics. A company can sell a large number of expensive flights and still struggle with aircraft leases, maintenance, crew travel, third-party lift, technology, sales overhead, and debt. Wheels Up has been simplifying its fleet, increasing the share of newer aircraft, and working with Delta Airlines and other partners. Its newer premium aircraft showed significantly stronger utility than the legacy fleet in early 2026. But the central lesson remains: revenue scale does not repair a structurally expensive network by itself. If the fleet has too many types, training and maintenance become fragmented. If aircraft are poorly positioned, empty flying increases. If guaranteed service requires expensive third-party aircraft, bookings can rise without contribution rising at the same speed. If debt funded yesterday's network, today's improvement still has to carry yesterday's obligations. The airplanes were real. The customers were real. The bookings were real. The loss was real too. A private jet company does not fail because nobody wants to fly privately. Same three jets, more than $6.5 million apart. It can fail because too much of the price paid by the passenger belongs to fuel suppliers, pilots, lessors, maintenance shops, airports, replacement operators, and lenders before it reaches the owner. That is the warning for our three-aircraft company. Adding airplanes does not repair weak trip contribution. It scales whatever economics you already have. Now build our three-aircraft company. The model is fictional and educational. The aircraft type is fixed, 3 early-model Challenger 300 series jets. The purchase prices, rates, utilization, repositioning, direct costs, and financing terms are explicit assumptions, not national averages or investment projections. You acquire 3 older, higher-time aircraft for $8.5 million each. That is an aggressive purchase assumption near the lower end of current asking market examples and would require serious pre-purchase inspections. The aircraft purchase is $25.5 million. Conformity work, initial maintenance, cabin updates, training, insurance deposits, systems and working capital add $3.5 million. Total project cost is $29 million. You finance 65% of the aircraft purchase. Debt is $16,575,000. Equity is $12,425,000. The loan carries a 7.5% rate and amortizes over 10 years. Annual debt service is approximately $2,361,000. Now operate the fleet well. You focus on dense business and leisure routes across the eastern United States. The aircraft are the same series, simplifying pilot qualification, parts, scheduling, and maintenance. Each aircraft generates 50 live charter hours per month. Across 3 aircraft and 12 months, you sell 1,800 occupied hours. This is an aggressive high utilization case for a small operator. It sits below the 56.1 monthly utility reported for Wheels Up's Challenger 300 series in early 2026, but the Wheels Up figure comes from a much larger network and is not evidence that a new 3-aircraft company should expect the same result. Your modeled average operator revenue is $12,000 per occupied hour before taxes and trip-specific pass-through charges. Annual flight revenue is $21.6 million. Repositioning represents 28% of total aircraft hours. To produce 1,800 live hours, the fleet operates 2,500 total hours. 700 hours carry no paying passenger. Direct operating cost averages $5,100 per actual aircraft hour. This includes fuel, routine hourly maintenance, and engine program accruals, trip crew travel, handling, and other movement-related expenses. Direct operating cost totals $12.75 million. Now add fixed cost. salaried pilots, benefits and recurrent training, insurance, hangars and subscriptions, maintenance administration, dispatch, safety, sales, customer service, and corporate overhead. Together, fixed fleet and company cost totals $4.4 million. Revenue, $21.6 million. Direct operating cost, $12.75 million. Fixed cost, $4.4 million. Operating cash before financing is $4.45 million. Subtract approximately $2.36 million in annual debt service. Then, set aside $750,000 for major inspections, refurbishment, and capital replacements not already included in the routine hourly maintenance accruals. Pre-tax cash flow to equity is approximately $1.34 million. On $12.43 million of equity, that is an illustrative cash yield of about 10.8%. That is a successful year. But it is not effortless luxury money. You invested more than $12 million. You operated 2,500 aircraft hours. 700 of those hours were empty. And after debt and major reserve, the company retained only about 6 cents for every dollar of flight revenue. The model works because the aircraft are standardized. Occupied utilization is unusually strong. The build rate holds and repositioning is controlled. Not because the aircraft are expensive. Now, buy the same 3 aircraft with the same capital structure. The cabins are identical. The range is identical. The debt is identical. But the sales team accepts trips without protecting the network. The company chases glamorous one-way flights into thin leisure markets. It promises availability across too large a territory. One aircraft spends weeks away from the strongest demand corridor. Another develops a maintenance issue in a city without the right support. The third is used to rescue customers from the first 2. Each aircraft now produces 30 live charter hours per month. Across the fleet, you sell 1,080 occupied hours per year. This is still real activity. The airplanes fly. Customers post photographs. Invoices go out. But the revenue base is much smaller. Competitive discounting reduces the modeled average operator revenue to $11,000 per occupied hour. Annual flight revenue is $11.88 million. Repositioning now represents 42% of total aircraft hours. To produce 1,080 live hours, the aircraft operate approximately 1,862 total hours. About 782 hours are empty. Notice the cruelty of that comparison. The strong fleet produced 700 empty hours while selling 1,800 live hours. The weak fleet produces even more empty time while selling only 1,080 live hours. Direct cost also rises to $5,400 per actual hour because the company buys fuel in worse locations, moves crews inefficiently, and uses more outside maintenance and handling support. Direct operating cost reaches approximately $10.06 million. You reduce some variable staffing and sales expense, but the certificate, pilots, insurance, hangars, systems and management structure do not disappear. Fixed cost remains $4.1 million. Revenue is $11.88 million. Direct cost is approximately $10.06 million. Fixed cost is $4.1 million. The company loses approximately $2.28 million before financing. Annual debt service is still approximately $2.36 million. The company sets aside only $550,000 for major inspections and capital replacements. Reducing the reserve does not repair the current year. It creates a future maintenance risk. Pre-tax cash flow to equity is negative by approximately $5.19 million. Same airplanes, same purchase price, same lender. The difference: between the two modeled fleets is approximately $6.53 million in annual cash flow. The weak company does not need a recession to fail. It only needs too few occupied hours, too much repositioning, and a rate that cannot carry the network. At that burn rate, cumulative cash losses would equal the original equity contribution in roughly 2.5 years before considering aircraft resale value, debt reduction, or taxes. The aircraft may still have substantial resale value, but now the owner is selling because the company needs liquidity, not because the market timing is attractive. This is how an asset that looks like luxury becomes a forced sale. Not because nobody booked the jets, because too many of the hours between bookings belonged to the owner. So, should you buy 3 jets? Probably not as the first move. The 3 stages from the beginning now become a sequence of proofs. Start as a broker or charter sales company. Build a customer base without pretending to control aircraft you do not operate. Learn which city pairs repeat, which customers travel during peak periods, which aircraft categories they actually buy, which operators deliver consistently, and which attractive quotes collapse after repositioning is included. Before you own an airplane, prove that you can repeatedly find occupied hours. Then manage an aircraft or work with an established certificated operator. An outside owner funds the asset. Your company learns crew scheduling, maintenance coordination, owner priorities, charter availability, and customer recovery. You build supply without financing every tail. Before you own a fleet, prove that you can keep one managed aircraft commercially useful without violating the owner's schedule. Only then consider owning aircraft. Standardize the type. One aircraft series is easier to crew, train, maintain, stock, and substitute than 3 unrelated bargains. Concentrate the geography. Owning 1 jet in Miami, 1 in Los Angeles, and 1 in Boston does not make you national. It creates 3 small businesses and a scheduling problem. Before expanding the map, prove that the next customer commonly begins near the last customer's destination. Then protect the company with working capital. If an aircraft breaks, you may need to purchase a replacement trip immediately. The operator that cannot fund customer recovery is 1 maintenance event away from damaging its reputation. And measure the correct hours. Customer hours are not aircraft hours. Live leg revenue is not total movement. Gross bookings are not gross profit. Trip contribution is not cash after debt and major maintenance reserve. Every operating report should show occupied hours, empty hours, total aircraft hours, average operator revenue per occupied hour, direct cost per total hour, customer recovery expense, aircraft downtime, cash after financing and reserve. Finally, decide which risk you want to own. The broker owns customer acquisition and supplier risk. The management company owns service and coordination risk, but may avoid aircraft capital. The fleet owner controls the asset and receives the upside, but owns debt, depreciation, and every unsold hour. The best entry model is not the one with the most impressive ramp photograph. It is the one where the party carrying the aircraft cost is being paid appropriately for carrying it. You began this video wanting to own a private jet company. The obvious asset was the airplane. Now the business looks different. The airplane creates capacity. The certificate allows you to sell it. The sales team fills the live legs. The operations center connects them. Maintenance protects the schedule. And the capital structure determines whether there is anything left after everyone else is paid. Demand for private aviation remains substantial. Honeywell's latest outlook projected 8,500 new business jet deliveries worth $283 billion over the next decade. 91% of surveyed operators expected to fly the same amount or more in 2026. But strong demand does not guarantee strong owner. Economics. A customer may pay $12,000 an occupied hour and still account for only half of the aircraft's movement. A company may generate hundreds of millions in bookings and still lose money. A jet may be perfectly maintained and still be in the wrong city. And a membership may create cash today while creating a difficult availability promise tomorrow. The winner is not simply the company with the nicest aircraft. It is the company that can sell access without owning too much idle capacity, position aircraft without wasting too many hours, recover customers without destroying margin, and finance the fleet without allowing the lender to become the real owner of every profitable trip. The passenger sees the cabin. You see the entire network required to make that cabin appear. They pay for the flight they take. You pay for the flight before it, the flight after it, and the aircraft that must remain ready in case something goes wrong. You thought the business was owning jets. The real business lives between the flights. The passenger pays for the flight. You pay for where the airplane must be next.